Good evening, everyone, from the beautiful Midwestern United States. It is June 1st, 2026. It's back to business Monday here in the market. Thank you for stopping by. We open the month of trading with, you guessed it, more of the same. More war escalation, more ceasefire, peace talks, and more wild price action in crude oil and the stock market. The headline of the day is Groundhog AI, aka Chief Market Optimizer, appointed to manage the market boom. You can see that he is endorsed by our supreme leader here. I knew he would never let us down. He's got his scope on to make sure that he can see things, very, very clearly. Judging from the books on his desk, he is well educated in the art of the pump, quantitative hope, narrative engineering, alternative data sets, and blowing bubbles. He's got some macros set up here. Looks like he can put in whatever mode that he wants the market to behave like, and it'll adjust these parameters here: fear off, logic off, doubt off, bullishness to the max. He's also got the money printer 5000 here to crank out some cash in case, the macros, aren't really working. And then he's got his little dashboard here to monitor, what he's doing. So right now it says market boom status optimal, inflation ignored, unemployment ignored, deficit ignored, reality ignored, narrative maximum positive. So he definitely has some very advanced and sophisticated methods of avoiding reality. And coupled with his extraordinary ability to circumvent the laws of physics, this should make it a snap for him to maintain the State of the Union's trajectory of perpetual infinite growth and prosperity here. Other points that the articles, inside are going to touch on are peace deals, how they're on autopilot. The truth index fell to a record low of about 7% recently. I think it's actually a little bit lower than that, where we're going to gather our, evidence for what's driving this index lower here in a minute. Wall Street is in party mode, looks like. Jobs reports are AI edited, redactions, are performed as necessary. It says real numbers are not required. Okay, I think they removed the requirements for actual facts a long time ago. It'll give a very healthy description of, how the bull market on steroids is, behaving, and, what's driving that as well. It says not sustainable, but it's very profitable. Consumers feel great, even though their credit cards are maxed out on things like basic survival. Global stability is reportedly confirmed as well, even though we see more and more military escalation every day. The situation on the ground just, gets worse and worse and worse. He's already got an approval rating of 95%. So, I mean, it looks like we're a go for a permanent state of utopia. And all thanks to AI, brought to you by big tech and their blank check. So let's look at a couple of charts and let's see what the market reaction to this is. So we have, let's get the S&P first. So the S&P hit another record high here at 76, almost 76.30. Let me get the exact. Oh, I'm sorry. It was higher than 76.30, 76.32. It was 76.25 this morning. It looks like we pushed up a couple handles higher before the end of the day. So the S&P is, obviously on a record run. 2 months in progress here from March 30th, the biggest bull run in the S&P's history, from 6,400 up to 76.32. Excellent job. NASDAQ hit another record all-time high. 30,693 here is the high. That's up 35-40% now in a couple of months. This thing is absolutely unstoppable. The AI mania just continues. We've had 1, 2, 3, 4, 5, 6, 7, 8, 9 sessions in a row. We got like 9 weeks in a row up now. So we've got 9 sessions in 9 weeks. You know, maybe we can go for 9 months, and then eventually 9 years, and then 9 decades. This thing is just going to go up, you know, forever. What I wanted to do is I wanted to check the maximum decline here on the way up, and I've got a little formula for that. And the reason that I wanted to do that is I wanted to see how this rally is going to stay healthy, and one of the metrics I use for that is the maximum decline. So what we're going to do is we're going to measure the up and down movement since March, and I've got this chart here. And here are the price bars. These are 30-minute bars, so the chart looks kind of small, but just to try and pay attention to this blue line here. So this blue line is going to be the maximum decline. So when the market dips and then it makes a new high, so we're going to zoom in on this little area right here. So here's where the rally started. We went up, then we went down, and then this point right here, we're going to measure when we make a new high. So as soon as we make a new high right here, we're going to measure the decline from this point to this point. Got that? Okay, so it's going to be this point right here that makes a new high. We're going to measure the old high minus the decline, and then we're going to plot that forward. That's going to be the maximum decline here. So we're going to ratchet that decline up as we rally, and we're going to keep track of that line. And as you can see, we touched it once here, looks like. Right here, we touched that maximum decline around 28,800 area a few weeks ago. And then we rallied, we made a new high off of that. So that's going to move the decline up. Now, that was about a 3-4% correction that was bought up. And now here is the decline. We saw the, we flirted with that decline earlier a couple weeks ago, after 1 week after the initial touch to the decline here. And then we made a new high off of that, so the decline updated once again. So we got one decline update way back, then we got another decline update right here, and now this decline right here, this is the one that we're measuring now because we have not hit that decline since. So if I go to where is GPT? I gave GPT the prompt. I said the high is in NQ is 30693. Let me fix this for a second. So I gave GPT the prompt. The high in NQ is 30693. The maximum decline is 29593 at the moment. So of course those, you know, values from the chart, right? So I've got the high here, and then I've got the maximum decline value, right? And then I'm going to put that in, and we're going to calculate what is that in percentage move. So the numerical decline is 30693 to 29593, 1100. Percentage decline from the high is going to be that high minus the maximum decline over the maximum high times 100. So that's going to be 3.58%. So the move from 30693 down to 29593 is approximately 3.58% decline from the high. Why is this important? Well, it's important because this is the maximum decline. This is where the market is being bought from. This is where investors and traders are picking up the market on the dip. So the idea is that as long as this 3 or 4% holds, then what we're looking at is we're looking at a bull market that is intact. In other words, the decline, the average decline, maximum decline, the extreme of the decline, the average decline's in the middle, the maximum is out on the edge. The maximum decline is holding the market, right? It's being supported here. So if we all of a sudden see that the maximum decline is trading, we know that that's probably a good buy area. And we also know if the maximum decline gives way, that this is a sign that the fundamentals underneath the support in the market is breaking, and we might want to rethink about purchasing the market. And we also want to maybe start managing risk if we own the market, right? And then the market is starting to trade against us as we own the market. We don't want to be caught holding the bag because there's so much momentum built up in here now that any sort of meaningful correction could quickly turn ugly very, very fast. So let's check out a couple of articles that go along with the theme here. So we've got Perfection Prevails. This is the mood that the market is in, where nothing can ever go wrong. Our 1997 analogy remains the chart that keeps us from turning outright bearish. There are plenty of tempting short signals out there, but markets driven by momentum and speculation rarely stop simply because they look expensive. The trend persists until it doesn't. For now, perfection continues to prevail. The crowd keeps chasing upside, leverage keeps building, and downside protection remains unwanted. History suggests that can continue longer than expected. Well, it already has continued longer than expected, and it also is continuing obnoxiously despite the worst energy crisis in history. History also suggests that it eventually matters. So, numbers and actual facts might start to matter. Let's look at the thing that everybody does not want to acknowledge right now real fast. Let's look at the reality of these facts and physics that may come into play here very, very soon. So, of course, we've got the energy doomsday clock. And the strait has been under blockade for 93 days, 23 hours, 22 minutes, and 30 seconds here. Despite all of the headlines about ceasefire and reopening and everything's going to get back to normal really, really soon, we can see that we are missing 1.3 billion barrels of crude oil since the closure of the strait. This is a catastrophic destruction of 13.3% of the world's supply of crude oil on a daily basis. This is 2.88 times the biggest crisis on record, the 1973 Arab oil embargo. I've got the countdowns working here. We can see the Cushing countdown clock here, where Cushing is approaching the operational minimum. That is the oil storage facility in Oklahoma. And we've got about 1 day left until the Cushing facility hits its operational minimum of around 20 million barrels. The actual operational minimum could be lower, 10 to 15, but it's really never been below 20. And most of the people in the industry that are experts at analyzing this are say it's around 20. So it's about to empty. It's about to hit its tank bottom right here. It's operational minimum. So something definitely has to be done about that. Commercial crude here says we got about 250 days of commercial crude, and the SPR we got about 172 days left in the SPR according to my calculations. Now the biggest CEOs of oil companies, particularly Exxon and Chevron, they came out on Bloomberg interviews last week, and they said that we're actually much closer to these operational minimums than my calculations say. They were talking about tank bottoms being hit in as little as 5 or 6 weeks. So this is obviously much more compressed than the window of time that I've given it here. So those are the people in the industry that are actually in the oil business. Like, this is all they do. So if they're saying that we're going to hit tank bottoms in 5 or 6 weeks, they can see everything that I can't see. There's there's a reason for that. So the SPR remaining estimate with the 4-week average draw from where we started at 415 at the beginning of the war is about 352 right now. That's an estimate. The distillate stocks are estimated at about 97. That's things like jet fuel. Commercial crude estimate is about 434, 207 in gasoline, and of course Cushing, which I talked on. So those are the actual numbers and facts behind the reality of the situation in the energy crisis. So if we go back to the article here, we'll continue. Upside panic in a picture. SPX low delta calls have exploded as the crowd is desperate to show upside exposure. And nobody wants to be left out here. Everybody wants a piece of this boom, right? It's a mania. It's an AI parabolic rally. Endangered species. Nobody wants protection. SPS puts now are trading at relatively cheap levels despite one of the most speculative rallies in years. So nobody wants put protection. Who needs put protection? The market only goes up, right? It doesn't go down. The crude oil goes down, market goes up, crude oil goes up, market goes down. It's the inverse relationship of what's actually happening in here. So people are completely ignorant of the fact that we have the worst energy crisis in history. That's why crude, seemingly goes down, even though we have, you know, commercials and crude stockpiles approaching operational minimums. And the stock market just continues to go up and up and up and up and up. So who needs puts in this environment? There's no risk in this environment. We can just buy the high tick and it'll all work out, right? Nvidia increasingly looks like the funder of the latest semiconductor squeeze. The stock has struggled even as large parts of the semiconductor complex continue to rip higher. One possible explanation is that Nvidia has become the hedge. Investors remain structurally bullish AI, but rather than reducing semiconductor exposure outright, they are trimming the most crowded and liquid position in the space to fund new longs elsewhere. So everybody that got in Nvidia early on is now selling Nvidia and is now buying all the things that, didn't rally as much in a hope to catch some more tailwinds in the AI rally there. So there's a rotation here of the early risers. We're going to get out of those. And then we're going to try and, pick up the laggards, hoping that the rising tide lifts all boats. This is a rotational kind of trade that's going on right here. If true, the irony is that the market's favorite AI stock may now be acting as the source of liquidity for the rest of the AI trade. Very interesting dynamics here. The dynamics of a completely out of control speculative bubble. The correlations crash. The crash in implied correlations has been epic. This is no longer an index, but an AI stock picking market. That is bullish initially, but it also creates fragility as more capital gets crowded into fewer names, crowded trades. That's not a good situation. When too many people are in the same trade, that's usually when things don't work out very well. When leadership finally stumbles, the broader market tends to notice. So this is not a broad, market rally here. This is purely driven by AI hype and semiconductors. Semiconductors have rallied more than ever. The SOX index is, primarily where all these gains in the NASDAQ are coming from because the NASDAQ includes semiconductors. Crashing implied correlation is the market's way of saying investors would rather chase the next AI winner than pay for protection. So let's just buy more tech stocks. That's it. There's nothing else to do in this environment. Let's just buy more tech stocks and let's not hedge and forget about, protection and, everything will work out, right? The software squeeze. On April 14th here, we laid out our contrarian software thesis and wrote IGV has been absolutely crushed, but is now sitting at major support just as positioning looks washed out and momentum starts to turn. After 4 failed attempts to set up for another bounce is building again. Fast forward to today, and IGV has rallied roughly 45% from the April lows. The ETF is now approaching a major resistance area. The setup remains constructive, but after a move like this, we are not looking to get greedy. Latest tactical update on software here. So the article has a couple more metrics on, positioning and cases. The BTC, let's check in with Bitcoin, because Bitcoin is related to the technological advancements in AI and the wave of the future here. So BTC is traded one way only since hitting the 200 DMA in mid-May. Momentum remains extremely poor as the breakdown extends today. The 65K area is shaping up as must hold support. So, although AI and technology and semiconductors are rallying, Bitcoin is not. Investors are not really looking at continuing to pump up Bitcoin in this environment. They would rather buy tech stocks. We say follow the flows here. The Bitcoin top coincided with the moment the AI narrative went parabolic. So everybody that was, riding the Bitcoin wave jumped off of that train and onto the AI train. Looks like a little bit of a rotation there as well, selling Bitcoin to buy tech stocks. One possible explanation is that speculative capital has simply found a higher beta home in AI. In our view, SK Hynix remains one of the key AI mania names to watch. Is an AI bear market the only thing that can bring those flows back to crypto? I don't know. Is crypto a flight to quality? Gold seems to be uh, undergoing a bit of a rotation and benefiting from a flight to quality lately. The gold market has bottomed out at about 4,500 and it's rallied a little bit, but it's not going down anymore. It has been going down overall over the last 2 months, and it has found a pretty good value here. So maybe Bitcoin and gold are, bottoming out here as, people want some value while this rally continues. But still, the interest remains in AI predominantly. On Wednesday, we are going to get the oil inventory, so I'll be able to update the oil model right here. So we'll look at the flows. We'll see what the actual numbers are after we get the inventory reports. So that'll be on Wednesday morning. Tomorrow is going to be probably more of the same. It's going to be Taco Tuesday tomorrow, but there's nothing really to chicken out about because the war appears to be back on. We did see some ceasefire headlines. Israel supposedly is going to stop attacking Lebanon. That's according to Trump, but we don't know if that's true. When that did come out, it looks like that came out early this morning. The crude oil had rallied a lot from about the 90 level up to 94 early on, and then in a couple of hours it gave back all the rally and then some. And then the NASDAQ market, which was going down, it had lost about 200 points from the high. It based out at about 30,300 and rallied 300 points from there. So over the course of the day, the crude oil had rallied. Then the crude oil, gave back all the gains on the, ceasefire, talks again, and the market went up. And it's just more of the same over and over and over again. So we're probably going to get a similar pattern tomorrow, but we shall see. Where overnight the military escalation, starts to, you know, make its way through the headlines, more, fighting, more skirmishes, more military operations, right? Like the war is in full effect here. Like the war is getting worse. It's not getting better. So by the time we wake up, crude's got a bid to it, crude's marching up, and then, there'll be some, ceasefire headlines that knock down the price of crude, and then, we'll bid up the stock market. So that looks to be, the script for the market tomorrow with groundhog AI in charge of market operations. Now I would definitely expect more of the same. This is not going to change until the reality of the crude oil situation really starts to show itself in the form of actual major interruptions, and according to Exxon and Chevron CEOs, actual shortages will develop. So we will check in tomorrow around the same time. I look forward to seeing you guys there. Until then, take care.